Are we headed back into a recession anytime soon? Is inflation right now a very serious concern? And most importantly, where should you be investing in right now and allocating your assets? Peter Berezin is our next guest. He is the Chief Global Strategist and Director of Research at BCA Research. Prior to BCA, he served as the Senior Global Economist at Goldman Sachs and a researcher at the International Monetary Fund. Peter, it's your first time on Kitco. Welcome.
Good to be with you, David.
Good to be with you. Full disclosure, I used to work at BCA Research as a researcher for a number of years before joining Kitco. I never had the pleasure of working with you directly, though, but I've always admired your work, and you've always struck me as somebody who is cautiously optimistic, as we used to say. We're going to be touching on some of that optimism today and some of the things you're cautious about. I want to start by talking about the broad macro picture. I've spoken to several economists over the past few months with various viewpoints ranging from very optimistic to very, very bearish. Now, do you think we are falling back into another recession? We just got out of one. Some would argue we're still in one. But do you think we might recede back into negative economic growth anytime soon?
Well, I think growth is certainly peaking. I mean, it probably peaked in the US in the second quarter. In Europe, it'll peak in the third quarter. But it's peaking at a very high level. We're talking about like 7-8% in the US, slightly less in Europe. So of course, growth is going to come down. The question is, how fast will it come down? And will it come down to a point that we have to really talk about the risk of a recession? I think it's going to take a long time for growth just to get down to trend. Right now, there's a lot of supports in the form of very easy monetary policy, very easy fiscal policy. And yeah, things are getting a little bit tighter at the margin. We're not going to keep sending out stimulus checks to households every 3 months. But households right now in the US are sitting on 2.4 trillion in excess savings. That's a lot of dry powder that they can and will deploy to finance consumption over the next 12 months or so. And if there's anything that I've learned in my many years of being a strategist, it's that you generally want to stay bullish on stocks if growth is strong, and growth is still strong.
Okay, I just want to touch on the savings rate before we move on. That's a very good point, that households are sitting on a lot of dry powder. Typically, let's look at the U.S. market, for example, in particular. Now, when you examine household consumption patterns, can we make a parallel to what happened to Japan in the 90s when people saved up a lot of money, they never spent their excess powder, and the economy fell back deeper into a deflationary mode? Could that happen in the U.S.?
Well, Japan had a massive bursting of both its property bubble and its stock market in the early 1990s. And that set the stage for a very deep and painful period of deleveraging. In the US, households are in pretty good shape. Since the global financial crisis, household debt has fallen by around 20% as a share of GDP. And so households have the ability and the wherewithal to spend some of this excess cash that we're discussing. And by the way, they don't have to spend all of it. 2.4 trillion. The US is a big economy, but 2.4 trillion is like 15% of GDP. They only spend like a third of that money. Then that's still going to be enough to power growth for the foreseeable future.
Do you think, well, that's a big question. Do you think they would, or do you think savings habits are here to stay?
Well, we don't know exactly what they're going to do with this money, but we do now have some data on what households did with the first round of stimulus that they received under the CARES Act. And it looks as though they spent about a third to half of that money. Now, consumer confidence is rising. The pandemic is ending. The job market is strengthening. In that sort of environment, usually people spend more. They save less for precautionary reasons, and hence they spend more. So I would expect a good chunk of that money to be spent, maybe not immediately, but over the next 12 to 18 months.
Okay, let's talk about the jobs market now. As you know, the unemployment rate has been trickling down. It's now at the lowest level since the start of the pandemic. Why is there a labor shortage right now, Peter?
Well, there's a labor shortage for a number of reasons. One, you have very generous unemployment benefits. For lower wage workers, the benefits exceed the amount of income that they received while working. So it's not surprising that for a lot of these lower wage workers, they're simply not looking to go back to work right now. You still have the after effects of the pandemic. Schools are not fully open. If you look at labor force participation amongst mothers with young kids, that has not recovered, whereas it has recovered for other demographic groups. And I would also add that immigration flows have really dried up. If you look at the number of worker visas that the government has issued, that's down like 90% since last year. But the important point is that these are all temporary factors. President Biden just reversed Trump's decision to end the issuance of visas. That problem is going to go away for firms looking to recruit labor. The enhanced unemployment benefits will end in September, and hopefully by then the schools will be open again. So what I see right now is temporary labor shortages that most likely will subside.
Okay. Now, the labor force participation rate you brought up, it has dropped by 0.1% from April to May. Is that all due to the enhanced employment benefits?
It's partly due to that. I think it's also due to the fact that people are worried about the virus. That worry is fading, but it's still there. And especially, I think, a worry for people who are engaged in service sector jobs. And at the same time, because households did receive so much in financial assistance, they can be a bit more picky in terms of finding jobs. And I think all of that is curtailing labor supply.
I think the people, the audience watching this program right now have a few questions. One of them is that, do you think wages will outpace the growth of inflation? Because that's what people are really concerned about right now. We know there's inflation. We know it's a 5% headline CPI. Do you think wages will grow at a pace faster than 5%?
I'm not sure if they're going to get up to 5%, but we want wage growth to increase. Real wages have been stagnant for almost 40 years. We want real wages to go up. We want labor share of income to rise. That will make the economy a better economy, a more equitable economy. The question is how much? Obviously, we don't want wage inflation to the point that consumer price inflation rises so high that we have to worry about a stagflationary episode. We're certainly not there yet. I mean, if you look at the Atlanta Fed wage tracker, which is probably one of the cleaner measures of aggregate wage growth, if anything, it has decelerated over the last few months. The areas where you're seeing meaningful wage growth are exactly the areas where you would expect to see it, in sectors such as leisure and hospitality, where wages on average are very low, and so there's less incentive for people to seek out those jobs.
Yes. Let's take a look at this chart now, Peter. How are you interpreting this chart? In the top panel, we have jobs openings. In the bottom panel, we have the quits rate. Skyrocketed earlier last year, and it came back down. What's happened there? Can you tell a picture?
Well, it's going back up. It's going back up now.
Going back up, yeah.
And we just got the latest round of data a few days ago. The job openings rate, I believe, is up to like 6% now. Oh, wow. So we clearly have a tight labor market, no doubt about it.
Why are people quitting? Why are they quitting their jobs?
Well, the quit rate is a measure of worker confidence. It's the take this job and shove it indicator, right? If people are confident about their ability to find work elsewhere, then they're more likely to quit. So in some sense, it's actually good to see a high quit rate. What's puzzling is that we're seeing these sort of high levels of job openings and high propensity to quit one's job at a time when overall employment is still down 5% from where it was prior to the pandemic. But as I mentioned, I think we can explain that by making note of the fact that unemployment benefits are still very, very generous. Immigration has been cut off. And a lot of people are kind of reluctant to work because they're looking after young kids. All of these issues are going to, in some sense, resolve themselves once the pandemic hopefully becomes a thing of the past.
When you look at the top panel, when you looked at that data for the first time, were you surprised? Some people might look at that and think, wow, gee, now a lot of small businesses across America closed down, some permanently. Why are there still so many jobs opening back up? Are they? I mean, how did the businesses opening these jobs stay afloat over the last 12 months?
Well, in many cases, they received government assistance in the form of the Paycheck Protection Plan. That certainly helped. But clearly, for them to continue to operate, they're going to have to hire workers.
Yeah.
And hopefully, it will become easier for them after September when more people will be rejoining the labor market.
Okay, let's talk about inflation now. Let's talk about a topic that many investors are concerned about. We see now the highest rate of inflation since the great financial crisis of 2008. Is this due primarily to the decline of the unemployment rate, or is this due to other forces, including the rise of the M2 money supply and fiscal policy?
Well, I would say it's really none of those. What I think it's due to is a lot of temporary factors. So, for example, at the worst point of the pandemic, rental car companies naturally feared for their survival. Some didn't make it. And so what they did is that they rushed out to sell as many vehicles as they could into the secondhand market, thereby raising cash. And now what they're doing is they're trying to rebuild their fleets at a time when auto production has been curtailed due to a shortage of semiconductors. And so you're seeing used car prices go through the roof. You're seeing new car prices go through the roof. This is temporary. It's not going to last. There's no inability of the global economy to produce more vehicles. You just have to wait a few more months. And likewise, if you look at really what's driving inflation, about half of that 5% number that you cited is simply due to base effects. Prices went down during the pandemic, and now they're recovering to more normal levels. If you look at the price level as opposed to the inflation rate, what you generally see is that the price level is kind of where you would expect it to be based on the pre-pandemic trend.
Okay, so inflation is not a big macro thing for you. You're not positioned to make reflationary trades right now?
Well, I'm positioned to recommend investment strategy that assumes that inflation will come down, thereby giving the Fed greater scope to maintain fairly accommodative monetary policy. And historically, if you have solid growth but a lack of inflation, the monetary policy normally remains accommodative. And in that sort of a world where you have good growth and easy money, that tends to be a world in which stocks rise.
Peter, one counter argument I've heard to what you just said is, well, why would prices come down? I actually had somebody ask me that on my program a while ago. Why would prices come down? If you go to the grocery store, food's up. If you break down the CPI last month, energy was the component that rose the most. Well, lumber price has risen, but it's come back down. Base commodities have risen. Why would these things recede back and revert downward, Peter?
Well, they already have. I mean, if you look at lumber prices, they've been falling for several months. Steel prices are down. Agricultural prices are down. If you look at DRAM prices, they've basically been trending lower since March. So a lot of this input price inflation that we're worried about, the leading indicator suggests that it has already crested and is already coming down. So it's not even a hypothetical anymore. It's actually happening.
Yeah. All right. Fair enough. So looking at the monetary policies that have been implemented over the last year, some economists I've talked to are concerned about the risk of potentially hyperinflation in the United States. And they point to other notable examples in prior decades in history. Weimar Republic, Zimbabwe, what's happening currently right now in Lebanon, and they make parallels there. Do you agree with any of these parallels, and do you think the U.S., you're already smiling, I think I know the answer. My question is, do you think the U.S. will experience high periods of inflation solely because M2 has never been higher?
Well, if you look at what all those examples that you cited have in common, from Venezuela to the Weimar Republic, these were economies that were in political turmoil. Almost always, hyperinflation is the result of political collapse. It's the result of governments who no longer can tax their households, their businesses, and are forced to print money to cover their bills. So if your view is that the US is heading for political collapse of the form that we are seeing in Venezuela, then yeah, hyperinflation becomes a real risk. But if your view is that the US will kind of muddle along, as it normally does politically, then I think hyperinflation is a very, very
well, let me just ask you very quickly, in the past decade or so, when we had, first of all, quantitative easing is not new to the States. We've had QEs 1, 2, 3, and 4 all throughout the last decade. Why didn't we see inflation at current levels back then?
Well, we actually did. I mean, if you look at what happened to headline inflation in 2011, it briefly went to about 4%. The producer price index briefly rose by 10%. So the same thing in 2008. I mean, there are oscillations in inflation. There are oscillations, even greater oscillations in manufacturing prices. And we're seeing one of these oscillations now. It's largely, as I said, driven by base effects. Prices went down a lot last year. Now they're going back up. That's not surprising, nor is it a harbinger of sustained inflation down the road. Now, if you ask me what's going to happen in 3 years, if interest rates are still at zero and fiscal policy remains loose, well, yeah, at that point, we could have higher inflation. But right now, there's still a large output gap. As I said, employment is still 5% where it was, 5% below where it was prior to the pandemic. We have to close that output gap before we really start to worry about inflation.
An employment rate is now at 5%. At what point should it come? At what point would that worry you? Would the unemployment rate come down to a level that would worry you as an economist?
I'd like to see it come down at least to where it was prior to the pandemic. We're nowhere close to that level yet. And don't forget, even before the pandemic, despite the fact that the unemployment rate in the US was at a 50-year low, we had very little inflation then. So to get worried about inflation, not only would unemployment need to fall to where it was maybe 18 months ago, it would have to actually go below that level. And it could happen, but it's certainly not going to happen anytime soon. This is potentially a risk for the next 2 or 3 years, perhaps longer, but it's not a risk for the next 12 months.
Okay, let's talk about investment implications now. I know that you think that stocks are a good place to be in right now. You said that in the start of the interview. People are worried about valuations, Peter. The PE ratio, trailing PE ratio, is at the highest point since 2007. Is this a concern for you? Is valuations a concern for you?
I think for any long-term investor, valuations have to be a concern. So if you're thinking about the next 5 to 10 years, the fact that stocks are expensive does mean that your expected return over that longer period should be fairly modest. But valuations don't matter that much over, say, horizons of 12 months. It's the business cycle that calls the shots over that period. It's the support that the financial system is receiving from easy monetary policy. And right now, with growth still strong and monetary policy still easy, I think it's still sensible to be in stocks. You know, we wrote a report in March of last year where we turned bullish on stocks after having briefly become cautious as the virus made its way out of China. And in that report, I asked whether the remainder of 2020 would end up looking like 1918, the year of the Spanish flu, or whether it would end up looking more like 1998, which was a year that also saw financial pandemic of sorts. you had a financial virus that emanated out of Thailand that spread to Indonesia, Korea, Malaysia, ultimately made its way to Russia and Brazil, and then engulfed long-term capital management. The S&P fell by 20% in October of 1998, and the Fed stepped in, cut rates 3 times, injected a massive amount of liquidity in the financial system, and we had the mother of all stock market bubbles. And I argued then, was controversial at the time, that probably something like that would happen again. And so we are in a bubbly phase, I absolutely admit it, but this bubbly phase is not going to end until we have a clear turn towards hawkishness from the Fed, and that's not in the cards, at least over the next few months.
So that's the main risk for you. To pop this bubble, we'll need to see tightening monetary policy.
That's right. We would need the Fed to say, listen, you know what? Yeah, inflation actually isn't going to be transitory.
Well, Janet Yellen came out and had a little Freudian slip not too long ago. If you remember, she said, whoops, I think we should raise rates. But then she backtracked and said, no, I think we'll keep them. Remember that? I know she's no longer part of the Fed, but that spooked the markets for a few hours. So I think maybe they're thinking about it. They're thinking about raising rates is the catchphrase.
That's right. But with interest rates still near zero,
all right,
thinking about it or thinking about it isn't going to be enough. They actually have to shift to a more hawkish stance.
And finally, asset allocation. Let's talk about your tactical asset allocation. How would you be positioned right now, given everything we've just discussed?
Well, despite the fact that stocks are expensive, the earnings yield on stocks, in the US, it's around 4% or so, 4.5%. That's not a lot, but it's still pretty high in relation to what you're getting from bonds. Bonds are yielding not just nothing in real terms, they're yielding negative in real terms. So if you look at the gap between the earnings yield on stocks and the real bond yield, it's still in the US around 5.5%. Outside the US, it's even greater. And this is a big difference between now and 2000. Like, people make a lot of these comparisons between today and the top of the dot-com bubble. But in 2000, the Fed was raising rates again. The 10-year yield got up to 6.3% at the start of the year. The yield curve inverted. Now, we don't have anything like that right now, which tells me that stocks are still the place to be.
Your preferred sector?
Well, we generally like the more value-oriented sectors, one, because they are cheaper, but also because the pandemic benefited growth. A lot of tech companies, in some sense, benefited from the pandemic. People had to do more of their shopping online. They had to go buy a laptop in order to work from home. The pandemic trade was a trade that favored growth, but the reopening trade is going to favor value. So we're recommending that investors maintain overweight positions in value stocks.